Hey everybody, Scott Riley, the Market Update Desk. It is April 30th, the end of another month. We're a third of the way through the year already. Unbelievable how time's passing. Today we got what I can just describe as an alphabet soup of data to go through. So let's start with these numbers and data that came out today. So, first thing that we saw was the personal consumption expenditure, PCE. Now, that's the Fed's favorite measure of inflation, and it's weighed pretty heavy in the bond market. So, within the report, we saw personal spending rise 0.7%, which was higher than the 0.5% than the market was expecting. Adding to the beat was a 1/10 upward revision to the February reading that was originally at 4/10, increased to 5/10. Incomes also increased, which was 0.5%, stronger than the market expected at 4/10. But there was a 1/10 revision to the previous month, which kind of tempers the report and gives a at expected for that complete reading. Now, the total PCE, the headline, was flat in March, a goose egg, zero, and decreased the year over year PCE inflation from 2.7 to 2.3%. Now, this was higher than the expected of 2.2%, but really, when you get into the rounding aspects of it, we were just within a whisker of the expected amount. The core rate, which strips out the volatile food and energy, and is the Fed's main focus within the PCE report, was also flat at 0% month over month. Year over year, it brought the core reading from 3% to 2.6%. That's a big drop, everybody. Now, the market was expecting an increase of 1/10. So we were a one tenth better than expected on that reading. When we go into shorter term analysis of the PCE, we see the 12-month rate at 2.6, as we mentioned. But when we look at the 6-month run rate, that dropped from 3.4 to 2.9, and the 3-month run rate dropped from 4.2 to 3.5%. So we did make good headway on inflation. One of the things that helped us out was a very favorable replacement cost and number that we dropped. Now, next month, we'll have another decent replacement number that we replace, but after that, it gets a little bit tougher sledding. Now, shelter, which is a big part of the report, had a monthly reading of up 0.39%, which was really the negative spot within the report, and it's continuing to be sticky at 4.3% year over year. But when you look at list reports rent analysis and Zillow, it shows that the numbers still within the PCE and CPI report are overstated for shelter costs. So it's just been a long sled to try to get these shelter costs back to where realistically they should be. The next one was GDP, gross domestic product for Q1. We were concerned about this. The Atlanta Fed's been giving us signals of concern on this, and it was reported at a negative 0.3. It's the first negative report we've actually had since COVID time, Q1 of 22, and does raise continued concerns over potential recession. Now, while growth was negative, the inflation component within the GDP on a quarterly basis was higher than expected and pressured bonds. This did give us a concern. This did hit bonds as they started out the day to a negative. Also, what hurt bonds within this report is the prices paid component rose greater than expected for goods. Now, personal spending was stronger than expected within the report, rising 1.8% versus the estimate of 1.2%. So a 0.6 hotter number. Also, helping that was a rise of inventories that added 2.25% to the GDP growth. But once again, that's a pull forward ahead of the tariffs that are here and uncertainty going forward. The main drag and spike was in imports. When we looked at the GDP, it took away about 4.83% from the total GDP component. Sorry about that. So the April ADP report, the other big number of the alphabet that came out today, showed that the market, private employers, only added 62,000 jobs to the market. Now, that's a little under half of what the market planned on of 120,000. Additionally, the previous report in March was revised lower by 8,000 to 147. So, very weak report. Now, within the report, we saw large businesses, which are greater than 500 employees, increased 12,000 jobs, which for them was very weak. We did get a little bit of a counterbalance. Small businesses are starting to pull ahead and get some more growth. They grew at 11,000 jobs. Medium businesses added 40,000. So those were good parts of maybe divesting this job growth from mainly being large companies. Leisure and hospitality led the way with 27,000 job gains, but we're going to watch that closely because it's going to be fairly impacted by, in the future reports, by potential slowdown in discretionary spending and travel. Trade jobs also saw job gains, but with the tariffs, it's hard to manage and calculate how those are going to go going forward. Education and health services had the biggest hit in this report. They lost 23,000 jobs. Job stayers had a flat job growth. They stayed at 4.5%. I'm sorry, actually decreased by 1/10. Last month's report was job stayers increased incomes by 4.2%, 4.6%, but the new report's 4.5%. It's the lowest level since June of 21. Now, job changers had a little bit of a bump. They saw job pay increases of 6.9%, which is up from the previous report of 6.7. ADP explained the cause for the weak report. Quote, unease is the word of the day. We've been talking about that, by the way. Employers are trying to reconcile policy and consumer uncertainty with a run of mostly positive economic data. It can be difficult to make hiring decisions in such an environment, end quote. We also see the Dow is down about 300 as we're looking today, right now. Mortgage-backed securities are flat, and 10-year bond is down 1 basis point to 4.17. So all of this alphabet soup of data gave us a flat in mortgage-backed securities and 10-year treasury. It's amazing with the depth and breadth of the data today. We actually got no movement so far for the day. Mortgage applications last week were down 4%. Purchases correspondingly were down 4%. Refinances now take up 42% of all mortgage applications going on. Now, here was a surprise. Pending home sales up 6.1%. That was a beat from estimate. Now, of course, Diane Olick, what did she say about pending home sales? Nothing. She avoided it like the plague because, once again, she's wrong. So we'll keep gathering information. Tomorrow will be a slower day, and then we get Friday's BLS jobs report. We anticipate the market reconciling and absorbing all this data. Probably not much of a movement yet today. The big thing will be Friday with the next main data piece. Give us a call. We'll help you get pre-approved, get the best loan program for you, and help get your offers accepted with our depth of the market, realtor relationships, and experience. Scott Riley, the Market Update Desk, your original singular market news source for West Michigan.